You're listening to Real Investor Radio with Craig Fuhr and Jack Bevere, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Hey, welcome everyone to Real Investor Radio. I'm Craig Fuhr, joined again by Jack Bevere. Jack, how are you?
Doing great, sir. Great to see you.
You're in a new location today, undisclosed.
Working at my Baltimore office on Calvert Street. So I got, I just saw I got T-Sizzle up there on top of Ben Roethlisberger, Terrell Suggs. So as it should be, Roethlisberger's on the ground getting sacked. So it's nice background.
It's Orioles season, Jack, and they won last night, so it's all good in the hood. Hey, listen, got an awesome guest today. Can't wait to introduce him to everybody. He's going to jump in on this news story that you sent me earlier in the week, Jack. And so we've got a really great content for you all today. Looking forward to jumping in. So, Jack, you sent me an article, sent Fred the article, a couple other folks in the company this past week from the Real Deal News, which is a great source. The article was entitled Arbor Modifies $1.9 billion in loans as delinquencies keep rising. And this is Arbor Realty Trust. They're a prominent multifamily lender who works across the nation to supply essentially bridge loans, right, Jack, to multifamily investors.
Yeah, one of their most popular products was a bridge loan. The classic one was a 3-year term with a 1-year extension, variable rate loan. Yeah. For value add deals, right? So like every multifamily syndicator from 2018 to 2022 was using Arbor 3+1s, and they do CDOs, collateralized debt obligations, with them to finance that business. Mm-hmm. But they're the holder of the risk and the servicer as well. So when we're when folks are talking about, hey, there's going to be some multifamily distress coming up at some point in the future with this refi risk, Arbor is one of the entities that is the ultimate bearer of a lot of that risk. So this is a really interesting article because everyone's always wondered, they've been talking like, hey, what's going on with Arbor's book? Because Sure. You expect them to, if there's going to be distress, you'd expect them to be the ones, managing it.
So the article quickly says that Arbor modified 39 multifamily bridge loans by extending the maturity dates and giving borrowers temporary rate relief. In exchange, some borrowers agreed to pay down principal, buy new rate caps, and deposit more cash into reserves for renovation or future interest rate jumps. So it says on about $1.1 billion in loans, borrowers put more cash into the deals, but only about 4% of what they owed. And, Jack, you're thinking like, well, it's 39 loans, right? Like, I mean, I'm sure they have a much larger pool. But I think, the canary in the coal mine, I'm hearkening back to, if you've listened to every episode of the podcast, you would have heard us speak about this in a couple of the initial podcasts where we kind of saw a tremendous supply of multifamily units coming onto the market. We wondered about the demand for those. And we also wondered more specifically about what was going to happen when these rates continued to rise and guys are holding, variable rate debt at 4%. And the general consensus at the time, I think Fred was on that episode as well, and possibly even Ron Phillips, was none of us saw a big foreclosure market coming, right? You guys were all of the mindset that it was going to be like, we're going to work these things out and kick the can down the road. And that feels a little bit what Arbor's doing right now. Would you agree?
Yeah. There was a debate, or I think there is still an ongoing debate as to, hey, when's the right time to time the multifamily market? Like, when should you get back in and start buying multifamily deals again? Yeah. And this impending distress that the rate resets are going to cause operators to have to toss the keys to their lenders, and as a result, the market's going to get flooded with inventory. That's one thesis, right? Yeah. The other thesis that I think we were kind of pushing, or I think is more realistic, is that lenders have no incentive to, or have every incentive not to foreclose on these properties and push a lot of inventory into the market, driving prices down, right? unless they have to, right? If the operator is just completely incompetent and mismanaging the property,
Mm-hmm.
yeah, sure, they may have to deal with those situations. But if it's just um, an operator who didn't get the rent increases that he projected and now can't afford the rate reset, but he can, but there is cash flow from the property. Um, my thought was they're going to kick the can, blend and extend the loan, kick the can down, and take what take what income they have, and
Yeah.
essentially the asset manager is just working for the bank. The equity holders aren't going to get distributions, but but they're not. But we're not going to see a foreclosure. The lender's just going to take what the property produces.
Yeah.
And this Arbor article really kind of speaks to that narrative as what they're doing.
I think,
So,
Jack, I think the more alarming data point in this thing, which they kind of gloss over, is that their delinquencies are up 70% since last December.
yeah,
I mean, they may not be foreclosing, but they're kind of on the verge of it with 70% delinquencies, wouldn't you think?
well, not 70% delinquencies. Delinquencies are up 70%, right? So that's like that could be 5 going to 8.5. That would be up 70%. So I
Okay.
don't think that they're like flooded with delinquent. I don't think that like most projects are underwater, but certainly there's an uptick in in operators not being able to make their full mortgage payment. Um, so I think that it's in other conversations we've had with that I've had with multifamily operators, their view is that now I've talked to a bunch of guys who think that now is the right time to be buying multifamily
Hmm.
because because the no other buyers are that because most of the buyers aren't that optimistic about big rent increases or decreases in operating expenses. So you're buying it on the real cap rate, and there's not a lot of like exuberance in the market to bid those deals way up.
Yeah.
And the other side of their thesis is and inventory isn't coming, and we're not building more right now, and there's not going to be a bunch of distress. The market is not going to get flooded with inventory from Arbor's just going to work it out, and so the prices aren't going to keep going down, and we've just gotten to a stabilized cap rate place. And if you're still bullish to American housing, now is the right time to be getting back into the multifamily side of things. And I hear that. I think that idea has holds water.
Interesting. Well, we'll keep an eye on it. So let's jump into a different asset class, Jack. Introduce our guest for today, Jacob Vanderslice from Van West Partners. Jake, how come you couldn't get your whole name in the name of the company, just half of your name? It really presents, it makes my mind hurt a little bit. So welcome to the show. I'll introduce you fully in a second, but man, it's great to have you on. Thank you for taking the time. Jake is a principal at Van West, and going to hear all about the company. And so welcome to the show.
Well, don't get me started on fitting our third partner's last name in the name. We got the third partner, Wade Buxton, and just couldn't get in there. But he deals with it every day. Yeah.
And I was reading about you last night, obviously from your website. So how does a guy go from being a firefighter to being a principal of, a very large self-storage company that you built?
It's really just repetitive failure over and over and over again. We got into the single family business back in 2006 and had a bunch of time on my hands because I only worked 10 days a month. Early 20s, knew nothing about finance. I was a history major, got my pilot's license, firefighter, and just started buying rentals. And got busy doing that and quit my job and been unemployed ever since then, I guess going back to 2006 now. We did a lot of fix and flips, rentals. We were buying deals at the trustee sales. Got into commercial real estate in 13 and 14 with some adaptive reuse retail projects. Did some townhome developments, some multifamily. And we looked at storage for a while, and we liked the fact that it's been historically downside protected.
Mm.
And one of the many problems with our business at the time, it was overly transactional. We were buying and selling too often and too quickly, kind of an eat what you kill model. And we thought that storage might be a good vehicle to kind of shift that thesis to cash flow and kind of long-term wealth creation. So we did our first deal in 15, and it wasn't really an intentional pivot to a new strategy. It was more just kind of try a deal out and see what happens.
Sure.
And it went okay. So we did some more, and just over time, we evolved to being primarily a self-storage owner operator.
Yeah, and so obviously you've blown that up to a pretty large scale. It's website says that you've deployed over 250 million in capital for value-added self-storage investments throughout the United States. So obviously, you know, have taken this on as your primary source of fun these days. So can't wait to hear more about it. Jack, why don't you jump in and let's kick this thing off.
Yeah, so I've had the pleasure of hanging out with Jake. He's in the mastermind, the Real Investor Roundtable Mastermind, for a bunch of years. And I remember when you guys were still still at that point where you were doing deals in the single family real estate side of things, trying some commercial out. But and I think that's a common story. Folks who are flippers, after a while they get kind of tired, right? Because you're always chasing the next deal. You're only as good as your last flip. You're paying ordinary income taxes on everything, and scaling those operations is challenging, right? Like there's a really tough maneuver, I guess, to try to, if you want to grow your business, building a pipeline that you can continually feed the machine while it pays for itself, and that there's enough left over that after taxes you're moving the needle for yourself. And so getting into more kind of like larger deals with more passive income is I guess a path that I think a lot of folks have taken, and self-storage has really blown up, I think, over the past 5 years, like in terms of the amount of investors who have gotten into that, and frankly, the amount of investors who have pivoted from single family into that space. So did you guys have staff in the flip at the time that you guys were flipping a bunch of houses? And if so, how did you repurpose that staff, or did you build the platform over from scratch? How did that go?
Yeah, I cut my teeth in the single family residential space, and I know and love it. I just like you guys, I can't tell you how many, flooded basements I've waded through at 2:00 in the morning with burst pipes and, shining a flashlight into a vacant house window at 10:00 at night before the trustee sale. We've all been there, right? We're street guys in real estate. It was real easy for a while, as we all recall. There was a ton of deal flow at the trustee sales.
And you're in Denver, right?
We're in Denver, yeah.
That's where
we were mainly doing deals in Colorado, but we did them all over the country. We set up operations in Vegas, Phoenix, Kansas City. We did quite a bit in the Central Valley of California. Most of it was in the Colorado Front Range, though. And back then, deal flow was easy. There was such a deviation from the mean, right? This massive price declines, tons of deal flow, and we didn't have to be marketers. You would just show up, max bid, stack of cashier's checks. So we had a bidding team, a driving team. We'd be underwriting deals up until the last minute, checking our title work, making sure we're buying a first lien. And as that kind of got more constricted and values went up, and our biggest years were probably 13 and 14. We did a JV with Starwood Capital back when the institutional players entered the single family space, and that was a lot of fun. I mean, we bought like 400 houses over 18 months or something like that. And then as the years went by, the market tightened up, obviously. Trustee sale activity really diminished, and we started having to do a lot more direct to seller marketing. And as you guys well know, that's really expensive. And if you're spending, 50 or 100 grand a month on your team and on marketing, and you're only getting a couple deals a month, you're lucky to break even.
Oh, yeah.
So we kept the business going really sort of on the side, and we got into storage in 15, but we were still doing our single family deals fairly actively, really right up until COVID. And we didn't stop because of COVID. It just kind of was, we're looking at the P&L and kind of the distraction. It kind of became more of a labor of love than it was a profit center. And there's plenty of guys just like you and many around the country who have stayed in the business and figured it out, and they're making money. And for whatever reason, we couldn't figure it out. We couldn't figure out how to make money on this massive marketing spend, load up enough inventory to justify it. So reluctantly, at least for me, I think my partners were more supportive of it. We shut it down. I call it paused, but we paused it, 4 years ago now. So I'm not sure if that'll ever reemerge.
It's like being laid off from a job that you never get called back to.
Right.
Paused.
Yeah, I mean, we miss the trustee sales and the thrill of the chase and the auction bidding, but it's just not there anymore. And frankly, when and if it does come back, there is so much money out there that's smarter with a cheaper and lower return target than we have, that if there's a big decline at some point, they're going to jump back in and pay pricing that we never could. So we miss it, but that was kind of the longer version of the pivot. And we've retained some of our staff back from those years. Others have moved on. You guys own a business, you get it. And today we've got about 90 employees around the country, about 20 of them in Denver here, and the rest of our staff are our various on-site managers at our storage facilities.
So how do you make that pivot, right? Like, because I feel like a lot of guys feel that pain, right? Like, and the flipping business is work, right? It's work. Hey, some people love it, and so they love producing the product. Some people are really into design. And so they pour themselves into their projects and they take a tremendous amount of pride in it. But I agree with you. I think that building a platform that just flips and does that year in and year out as the market continues to change, right? And competition happens, more competition comes in and out and cost of capital goes up and you have to deal with fluctuations in the market and frankly, and constantly staying ahead of the rest of the market from a deal sourcing point of view, I think is one of the hardest parts of it, right? Like we buy about 100 houses a year and it's a grind. Like it is a grind every year and you get one step ahead of everybody and then 6 months later they catch up and they're doing the same thing and bidding the margin back out of the deals. And then you got to come up with the next thing to get in front of, to get in front of the pack again. And that's a grind that just, I think, wears on people over time. And I think that's a pretty common story, but making that transition though is easier said than done. And so we started doing some self-storage deals. How did you learn that space? How did you wind down flipping operations and transition your mental energy and capital and team's energy into a completely different asset class? Like that's a hard transition to do.
Yeah, maybe you could talk about the sort of the first deal and learning how to underwrite that asset. How did you pick the market? I'm sure you're not on some major corner where Extra Space is. My guess is that it was kind of tertiary. Talk about that first deal and really learning how to underwrite a brand new asset class after you had so much success in the single family space.
Yeah, so I've got two partners, Westfall and Wade Buxton. And Wade, many years ago, he graduated from DU. Within the timing of the financial crisis with a real estate MBA, couldn't find a job. So he was mowing the grass on our rentals and our fix and flips. And we're like, hey, you want to come work in the office and help us bid at the auctions? And he said, great. So he came in. And then so he left to go work for this retail kind of strip mall investment shop called Baseline. He was underwriting deals for them. And we reconnected with him at about probably 13, and we're like, hey, we're looking at this commercial deal. Can you help us underwrite it? Whatever, pay you $1,000. And we're like, hey, you want to put some money into it? And so we called up grandma and got $100,000, and we partnered together on our first deal back in I think earlier mid 14.
Yeah.
And I have a point in this story, but his family built a storage facility. They're kind of self-made entrepreneurs out of Southern California. They built a storage facility when he was in high school. And they still own it, and they still obviously owned it at the time. And Wade's like, hey, we should do self-storage. We're like, oh, I don't know. So we don't know anything about that. So we started studying it more. And our first deal, I'm sure you guys have been there many years ago, but our first deal, we got this development project under contract in central Denver, basically the central business district of Denver, and didn't have any money to buy it. So we roadshowed this all over town, and we had raised a ton of money for a residential program. We've done a lot of volume. But if you're doing a new asset class, right, nobody cares what you've done before in the other
You're
asset.
brand new.
Yeah, first time at storage. Well, my partners did one,
Let us know how the first one goes. Maybe we'll come around for the second one.
Call us on number 10. So this last group that we took it to was the first group that said yes. And they're a multifamily and industrial shop here out of Denver. And they're backed by a number of life cos and, friends and family equity. They're a pretty good size. And they're like, we'll do this deal with you guys. And we'll bring you in as a minority partner in the GP. You'll participate in the promote and the fee income streams. And you guys will kind of be the lead, but we're going to do this with you and kind of learn this business with you. And on the first deal, they're like, you guys can use this to springboard at some point. You're not taking great economics, but build your track record up. And I'm like, oh, sure. Great. So we did our first deal with them, and it was roughly a $15 million development project in Denver. And we didn't know what we didn't know, right? They've developed big projects. We had to. But we didn't know storage, and we didn't appreciate the impacts of new supply, the future impacts of our homeless issues in Denver. That was a major problem on this deal. So we did our first one in 2015 with this group, and we ended up doing a total of 9 projects with them. 4 of them were in Denver, and 5 were in Milwaukee. And we, being the bootstrapping young bucks that we were like, hey, we're going to manage these. We'll figure out a way to manage these. And they're like, we got life insurance money in these deals. You guys are a bunch of real estate hacks. We're going to hire the REITs to manage this portfolio. So we said, okay. So we hired Extra Space, and they managed the portfolio initially. And again, you don't know what you don't know, but we learned over time, big surprise, I guess, that third parties don't care about your deal like you do, right? Mm-hmm. There's an inherent misalignment in expense load allocations, ancillary income streams. So we had one small deal in Wisconsin, and we couldn't get Extra Space to manage it, and it was too small. They wouldn't do it. So we're like, oh, I guess we have to do it. So like, okay, well, good luck. Go ahead and figure this out. So that was the first deal that we actually property managed in the storage space. And that was back in, I think, 2018. And we kind of built our management platform around that. And then eventually, as we learned the business and this partnership reached their allocation, we did our 9 deals. They didn't want to do any more. That was kind of their storage allocation. We wanted to keep going. So we started doing our own direct to investor single asset syndications and building our management company kind of deal by deal. And then once we reached some scale and we demonstrated some performance, we convinced our original partners to allow us to take a number of these deals back from the REITs and manage them under our management flag, which is Clear Home Self-Storage. And then if you kind of round trip the whole thing, we ended up firing the REIT. We had a regional operator manage some of the deals in Denver, and we managed the deals in Milwaukee. And then in mid 22, we sold the portfolio back to the same REIT at a 2.8 cap. So there's been a lot of signage changes on these deals over the years, but that's how we learned the business. And as you guys, I'm sure, agree, so much of value creation in real estate is driven by your ability to effectively operate. And every year we get less crappy at property management. We'll never be good enough, but we control it. We control the operating expenses. We control the revenue streams, and we're not relying on someone to give us a report once a month on kind of how things went. So that was kind of the evolution of learning the business. And then we kind of in between all this, we did our first fund in 19. Our second fund was in 21, and we're winding down our third fund right now.
So let me rewind a little bit.
Yeah.
So this first deal that you got these folks to give you a shot with, they basically said, "Hey, I'm taking part of your GP economics." So you worked for real cheap, but like you got, you're building the resume at that point. Is that fair to say?
Yeah, absolutely. I mean, they were so these guys. It's very difficult for 2 sponsors to partner together. Right. I mean, the way we all make money is we get some fees along the way, obviously, but we make most of our wealth in our promoted interest, right? After you pay all the pref, return all the capital, you get a minority shake. So it's inherently tough for 2 sponsors to do deals together. So we did this with them, and we were, they didn't so much take part of our GP. We made a general partnership with them, and we took a minority shake of that GP. So they were getting promoted interest as well. But yeah, it was diminished economics, which we were fine with, to kind of build a track record up and learn the business. And we went into this with them together, learning the business together along the way. And we applied a lot of the mistakes that we made to future deals. And the outcome of the partnership was positive in the end. We made money. We made a really good return. But we didn't know what we didn't know.
I want to get back to the MBA in real estate who's cutting grass for you. You know, he turns the lawnmower off and he says, yeah, I can underwrite that deal. Like, that's just the greatest kismet of all time. And now he's a principal in the company, correct?
Yeah, we've been partners now for almost 10 years. And with Wade and I and Aaron collectively been partners for almost 10 years, I think 10 years in June. And then Westfall and I have been partners together. We go back to junior high, high school, college roommates, but he joined me as a partner in 2008. So it's been a long road, for better or for worse. I'm sure both of them many days wish they turned left instead of turning right, but it's neither here nor there.
I'm guessing that I know the answer to the question, but I'll ask it anyway. If you had to go back and sort of take on that first deal again, I remember the first single family flip that I ever did. I had no money. Went to my girlfriend's father. He said, I'll put up all the money. You do the work and we'll split the profits 50-50. And I'm thinking, well, 50% is better than 0%. And I got to learn so much from that very first deal and wound up marrying the girl. So things, I guess, worked out pretty well. But the crazy thing is, here you've got such an incredible amount of operational knowledge, transactional knowledge in single family. And a lot of people, I think, would be really reluctant to walk away from that after having such success, raising the tremendous amount of capital that you did. But would you have had it any other way on this first deal? Not a whole lot of guys jump into self-storage and go, I'm going to do a ground up construction development deal for 15 million.
Wasn't a dip going by any means. Yeah.
Right. And so like that alone, I think would have just catapulted your experiential knowledge just in that first deal alone. And so when you look back on it, would you have had it any other way?
All the mistakes, all the failures. I mean, we've had deals go bad. I completely crashed and burned in 2008. Never had to BK, but didn't have a penny to my name. Right. I mean, I'm sure you guys were getting.
Well, that makes one of us. So
yeah, right. Yeah. No, it's and the mistakes that we've made over the years, we remember every day. And the home runs you can chalk up to luck, market timing. I'm sure there's some execution there and some operational prowess. But I really wouldn't change a thing. It's all been an evolution, and we've learned so much along the way. It's easy to look back and say I would have done all these things differently. And I guess the one thing I would say that I would have done differently is I would have had the discipline to hang on to assets.
Yeah.
Just the discipline to hang on versus smoking the crack of that sale and, that $50,000 cash to seller event, on the settlement statement and plowing that into the next deal. But, at the time, especially when we were just stealing deals relative to what they traded for previously, it was really hard to hang on to them. There wasn't financing out there. Everybody was terrified. You're trying to rotate capital as fast as you can. Thematically, we would have been more disciplined to hang on to more of our asset base. That's one thing that I would have changed.
Did your economics, did your cut of the GP economics improve over those 9 deals, or did you cut a single set of economics for all 9 of those deals?
It was slightly, this has been a while, it slightly varied from deal to deal, but we had roughly, we would co-invest and we had between, I think, 25 to 30% of the GP and a similar percentage of the fee income streams. So there were development fees, asset management fees, dispo fees. So it was more or less the same throughout all of them. Yeah, we weren't kind of increasing that as we got to the last deal because the GP is a relatively small pot, and you're splitting it with 2 shops, and our partners were the guys bringing the money bringing the debt, bringing the name and the gray hair, so to speak. So no, it didn't really go up over time. It varied between those ranges, but that's about where it landed.
So like, how did you afford to build your platform inside of those smaller economics? Or did you have to wait until you got past that and that was all resume building before you could actually start building your shop?
Yeah. Well, once we started, I mean, we had, we have a bunch of, we sold some off, but we have some adaptive reuse retail assets here in Denver. We get a handful of single
Hey, what's
family.
that mean? I always like, what is adaptive reuse? What does that mean? Like,
Well, it's a really great way to sound intelligent when you're not intelligent.
It's an old crappy Kmart, Jack, that is sitting there vacant. Go ahead. I'm sorry, Jake.
Yeah, since you're a real estate rookie, Jack, I'll boil it down into simple terms for you. It's buying a 20,000 foot, 100-year-old brick warehouse bomb shelter that's tired and busted. You put in demising walls, you make it beautiful, you update all the infrastructure, and you put a brewery and a restaurant and a yoga studio in. That's kind of the adaptive reuse concept. But yeah, we've done a fair amount of those. But when we were, as we were kind of getting close to making our last acquisition with them, we started, as I mentioned earlier, we started doing our own single asset syndications in the storage space and self-managing those. So we were kind of building our management platform in tandem with this partnership as it grew. And as you guys know, property management is not a very high margin business. It's a very, very low margin business, but it's such a critical component to value creation. It's something you got to have. So yeah, we built it in tandem, and eventually we took a number of these stores back and grew NOI, and then blew out to EXR and kind of kept adding to the asset base.
how much of like for the self-storage assets that you bought that after the first 9, how much of the profit as you look back on it today was attributable to buying it well or versus adding value, like you had a really creative idea and executed that business plan well, versus property management, operations execution versus the market? Like how did the value creation at the end of the day, how did the IRR that you were able to produce split between those 4 over the past, whatever, if you look at self-storage over the past 6-7 years?
I would say answering that question depends on when the deal sales actually happened. So I would say when we sold that 9 property portfolio in middle of 22, we did not deserve a lot of the value creation and the upside that the deal saw. I think most of that was because of cap rate compression. Mm-hmm. We had so many management company experiments on those, REIT managed, then a regional operator, and then we took them back. There was a lot of friction with transitions and customer service when you're putting a new flag on something. In the last, we managed the Milwaukee properties for the prior year before we sold them. And I will give us credit there because we saw a substantial increase in NOI compared to the T12 when they were REIT managed versus managed with us. Not to say that we're American heroes, but we just pay attention. We're not especially intelligent, but we watch the numbers really carefully. And we care. So no doubt that was a big component to it. But these deals were just kind of, they were pillaged over the years with high operating expenses, big marketing allocations, and one, which maybe we can get into in a moment, but one big piece of revenue in self-storage is tenant insurance, which you guys might have heard of before. It's the same thing as renting a car at the airport. You probably decline the insurance coverage because you have it on your auto policy, but the margin on that insurance premium that you pay is enormous. In our case, we might pay our carrier $2 a month per unit and charge our customers $20 a month. So the reason I mention that is depending on the REIT and how you're structured, some of the REITs keep all of that top line revenue for insurance for themselves. They don't share that with their third party owners. So that was part of the value creation when we took over, is suddenly all that insurance revenue that was going into their pocket was going into ours. So that was a big movement. But I would say on those deals, I don't know, I'd say 70-30 kind of market tailwinds, cap rate compression to operational prowess and kind of buying it right. On the deals that we've sold 6 deals in the last almost a year, about 10 or 11 months. And it's tough. Obviously, you're not seeing cap rate compression today, right? You're seeing the opposite. And a number of those deals, our lowest return on those was, by the way, I hate IRR. It's a BS metric, but we still speak to it and quantify it. The worst of those 6 deals did a 7% IRR, and the best did a 33. And I would attribute those kind of the opposite ratio. I would say even more so. Maybe storage still has some cap rate compression. There's still more capital than there is inventory, but I would say 80-20, execution, operational excellence, and then 20% on there's a lot of money out there, so cap rates are still fairly compressed depending on the market. So it kind of depends on when the sale occurred, but yeah.
Like you still pay attention to the residential space, I gather.
Oh yeah, absolutely. Yeah, as much as I can. Yeah.
Like how have those, like, is there a tale of two markets there, or have they kind of gone together with interest rates being like the driver, kind of pushing both of those forward? Or do you think that those are, or have those two asset classes experienced like two different, curves over the past 5-6 years?
This market is so confusing. I guess it's always confusing, but I mean, we sold. First of all, Illinois may not be the number one market you're targeting to deploy capital into, right? It's kind of got a bad rap. There's good stuff happening in Illinois, but not everyone's like, oh, let's go do Illinois. We sold 2 deals about 3 weeks ago in suburban, kind of central Illinois, at a T12 4.8 cap. And we viewed those deals as stabilized. We were 90% unit occupancy. We were 100% economic occupancy. And the buyer's a top 10 storage operator. And obviously their view was there was still some value creation. Maybe we're a bad management company and we're missing something there. But generally what's happening, so you still have some cap rate compression there, but in the storage space, at least, you're seeing distress, not necessarily distress, but it's hard to get C of O sales done. So if you're trying to sell a property like a merchant builder, you're trying to sell it new but empty, those are really tough to execute on. And I would say if you're likening kind of the two asset classes together, especially on the debt side, and I think you guys might agree with this, but lenders are a lot more focused on the T12 or T3 or T6 than they've ever been before. A couple of years ago, we were getting loan proceeds based on the dream. Like, we're going to grow NOI in year 1 by 15%, and they're going to size our loan accordingly. And they cared about the trailing performance, but not as much. Now, all of your financing is sized to that trailing. So if you have a deal that's very low performance or it's early stage lease up, those are tough to get financed. And you're not seeing as many trades. And the second component that we're seeing a lot more now is buyers are wanting to solve to a much more believable, stabilized yield on cost than they were before over a fairly short period. I think in storage, in many cases, guys are trying to get to a 6 or 7 yield on cost in, say, year 3, and a believable story to get there. But we haven't seen macro devaluation in the storage space. We're not jumping on the table and saying everything's down 20% or 15%, whatever the case might be. And it's just because deals aren't trading. There's not a lot of transaction data out there showing what deals are worth. And we follow the multifamily space. We have a lot of our LPs that are in various syndications and multifamily funds, and we're hearing more and more stories now of duress. And that duress is not necessarily underperformance in the deal fundamentals. It's a distressed capital stack, as you mentioned earlier on the article. Floating rate debt maturities. We can go on and on about that. But we're definitely seeing measurable increase in stabilized multifamily cap rates. But in storage, you could say it's gone up maybe 50 bips if you want to paint a broad brush on it. But there's still so much money out there, just classic supply and demand. There's a lot of equity that wants to be in the space, and there's very little inventory to buy.
So like I feel it was like over COVID or just before COVID, all of a sudden, like freaking a third of the resi investors in Baltimore all started doing self-storage deals. And there was a couple educators that were like just doing, week-long seminars or 3-day things, and you'd fly out to somewhere and then come back and then be like start sending direct mail to little old lady operators who had their 100-unit self-storage thing, and those guys just like so many of them did really sound, at least to me it sounded like they were doing really well with that. Like,
Yeah.
Has there been a maturation of the industry where like it took some of the inefficiency has gotten squeezed out of the self-storage space, or were those smoke and mirror seminars and that was all bullshit and there's some like fatal flaw that no one's talking about, right? Like, how should I be thinking about the guys who got out of resi 5 years ago and started doing self-storage and they haven't come back, right? And they haven't come back. So like, did they blow up, or are they doing very well quietly and I missed it,
Yeah, I'll specifically answer that question in a moment here, but I do want to touch on one thing. Everyone is always asking about track record, right? Track record, whether it's an institutional investor or a $100,000 retail investor, tell them about your track record. And I think track record means less today than it ever has before. If you bought a deal, pretty much any deal, whatever, 5 years ago, and you monetized it before early to mid or even late 2022, you probably hit a home run. And you might be a terrible operator. You might have been delayed on your construction project. You might have delivered it over budget, but you were saved by rising rents and compressing cap rates. Yeah. So when people are putting out their pitch decks,
the worse an operator you were, the better you did.
Absolutely. And when people are putting out their pitch decks and we look at our IRR track record and our multiple track record, the question always asked is, when did you do that? Over what time horizon? When did you get in and when did you get out? It's like people saying, I got a buddy who's done really well in the stock market. Well, when? When did he buy in? When did he sell? Yeah. And that track record component, it matters in that you've operated through cycles, you know what you're doing, you understand your asset class. But when a sponsor puts up a giant IRR a couple of years ago, today, just to a degree, it doesn't matter. To go back to actually answering your question, what's happening in the storage space as it relates to consumer demand. So we've seen, if you look at the articles out there and the data, you've seen a material year-over-year decline in street rates. Yep. And street rates purely mean what is the rent that the operator is asking for on their website. So like on the website, a 10 by 10 is going for $100 a month. So those street rates have declined materially year over year. Now, if you kind of pull back the curtain, you first of all, you might infer, rents are way down. That's not good. The asset class is in trouble. But if you look a little more carefully, what's happening, especially with the REITs, and we're doing this now more, we're kind of following what they do. Not in all ways, but they know what they're doing. But don't get me started there. But last year, the REITs started doing historically substantive move-in concessions, more than they've really ever done before. So getting customers to move in at a really cheap rate. And before they started doing this, the typical, so one of the little acronyms in storage is an ECRI, and that stands for existing customer rent increase. And they're all month-to-month leases. So these ECRIs are how all of us create a lot of value, or try to, in our portfolio. So before all this, the REITs would do ECRIs within like 9 to 12 months. So if the customer is still there in 9 months, they're going to see whatever percentage increase on their base rent. So what happened last year in conjunction with these more substantial move-in concessions is the REITs were getting someone in at a really cheap rate, but then they were more rapidly moving them up to market rates. So again, if you're looking at street rates, you see a year-over-year decline. But if you're looking at achieve rates, in many submarkets, you might see a year-over-year increase. But achieve rates are not as easy to get to as street rates, obviously, because it's not really public data.
You can scrape
So you've got 23 for consumer demand and storage was fairly rough. And when I say it was rough, you're coming off of a historic peak in consumer demand, right? I mean, the NOI growth that we saw in the years following COVID, us and other operators, was extraordinary. It was almost like the cap rate compression, rising rent story. I mean, there was so much demand, people clearing out their third bedrooms, their are moving to a more, rural location because they're working remote now. There was a big demographic shift that drove up storage demand, and that couldn't last forever, right? So 23 was kind of the year of moderation. But we're seeing consumer demand kind of come back. We've seen for March and April, those 2 months, and it's not even the leasing season yet, those were the highest occupancy growth months in our portfolio that we've ever seen before. And it's a different portfolio makeup. We bought some new deals, we've sold some others. But the high level story is street rates are down. Achieve rates, depending on your operational prowess, are probably the same as they were, maybe a little bit higher. But all these single family operators that might have gone into the storage space, their success or failure is probably driven by what was their debt going in. Did they go in with a floater or a fixed rate loan? What was the deal type? Were they building a new project and a bunch of new inventory came online and they got crushed? And what markets were they in? Just like every real estate investment, self-storage is so sub-market specific. Like right now, Phoenix is blowing up with new supply. It's probably a scary place to invest. Rents are going down, but there are pockets of Phoenix that still make sense. So it kind of depends on what they did and where they went. But just like anything, it's got a lot of risk to it. And
explain to me why a REIT would pay a 5 cap. Like what's the story that they're telling themselves in a 5% treasury environment? Why would you pay a 5 cap for self-storage, which is, I would think, like from a supply of inventory point of view, there are probably very few markets that are geographically supply constrained. So why do they think that there's upside in rents that would justify rather paying a 5 cap? Like, what's the story they're telling themselves?
Well, it's not just a cap rate exercise. It's also an exercise on replacement cost. Are we buying this deal for materially cheaper than it would cost us to build a new one? What's that look like? So that's a data point we look at too. I mean, the yield on cost, the cap rate matters, but what's your price per pound, right? If you're buying something that's pretty nice in a decent location, that's fairly new construction, and you're buying it for 25% less than it would cost you to build it, maybe that makes sense. Okay. But I think they're just like whenever you sell a deal, especially a deal that trades on a cap rate basis or a multiple of the NOI the deal produces, you're selling a dream, right? It's you've executed on your value creation, and you've left some meat on the bone, and you're selling this new dream to a new operator, and they might be paying a 5 cap, but in their model, which their models are probably as wrong as ours are, all models are wrong, but in their model, they're probably seeing a story to get it to 6.5% by year 3. Mm-hmm. But when you do the math, obviously, and you're thinking, all right, how can you finance it at 7 and buy it at 5? Mm-hmm. Obviously, it doesn't work, right? Unless you're really low leverage, you're probably losing money. The reason that's happening is that belief in that NOI growth upside. Yep. So that's probably their logic in paying a 5 cap.
So fascinating conversation. Looking forward to episode 2. Why don't we end this one here? And I'd love to jump in and talk a little bit more about that dream that, frankly, I had I don't know if I ever even mentioned this to you, Jack, but I had a chance to sit in on several of those seminars with a very well-known guru in the space. And I'd love to report what I saw amongst those sitting in the room, sort of the dream that you just mentioned, Jake. And that whole business model of, I'm going to buy it at this cap rate, we're going to add a little value, we're going to sell it at a better cap rate and make our money. I didn't see anyone in the room that was like, serious operator, we're going to hold this thing forever. It was all the dream of like, that back end 5-year pro forma that like never ever works out the way you said it, the way you just said, right?
Never, ever.
So we'll end this one here. Jack.
We have one more too. So I really want to dig in, Jake, on the fundraising aspect, right? Because you've fully made this transition to commercial real estate, which necessarily requires that you raise a lot of money. And I want to talk about that experience and how you guys have gotten good at that. So looking forward to the next one.
All right, we'll tune in for the next episode with Jake Vanderslice from Van West Partners. This is Real Estate Radio. We'll see you on the next one.
Thanks, guys.